now it is reality which is forcing markets to really readjust itself. That's my limited point here. Krishna Kumar Karwa, good morning. Thank you for joining us. So KK, long-term optimists like you and me, we always try to look at the bright side. It is glass half full for all of us rather than glass half empty. But somehow today I'm struggling. I'm struggling because the core assumptions like me and Tanveer were discussing, they've got challenged. They've got challenged on the interest rate front, on the oil front, and also on the earnings front.
Nikunj, rightly, as you rightly said, the macros are kind of challenging, and primarily in the last, absolutely right, oil has spiked to $80 odd, and that has very wide and large ramifications for a country like India, which imports a lot of its oil requirements. And yes, the macros are challenging. Because of that, obviously, you have currency also, rupee being where it is, which is almost at 68.5, and interest rates are also hardening. So these are the macro headwinds. But my sense is that we are in a cyclical upturn, as can be seen by the corporate performance in the Q3 as well as Q4 of many of the domestic-facing companies, etc. So there is this continuous mismatch between macro headwinds, but micro there is a lot of positives. And so there is, investors will be in a dilemma in this kind of situation of how to go about in the process of investing. I believe that valuations are going to be the key trigger which we have to be very cognizant of. And that's what we are seeing of late in the last few months, that since valuations have been kind of rich, people have been in the process of taking money off the table, and liquidity also is currently, as far as investing liquidity is concerned, it seems to be strong, but let's see how that behaves. So yes, very challenging environment from an investor perspective, from a short-term investor perspective. As usual, as you said, we always look at glass half full, and over a longer time frame, I think it all evens out.
A year, forget a year. Year is a long time because there is risk of election. 6 months from now, if you will recall and remember May 2018, for those who participated, they will get happy, or crowd which does not participate and protects the cash and capital will be happy?
Yeah, I think basic to say that to look at very short-term perspective is not the right way of looking at investing. Let's be very honest that every investor has its own asset allocation strategy and risk return payoffs that he has in his mind. So each individual on his own, etc. But the fact remains that if you are looking from a short-term perspective, then returns are going to be challenging. And going into cash and moving into equity, etc., to time that is always going to be a challenge. So my judgment is that it's best that you stick to your asset allocation strategy and accordingly have your cash and equity or cash and other assets in your portfolio. It's very difficult to be able to time your entry into the markets and again time exits also. So broadly keep an eye on valuations and your asset allocation strategy.
Right. Do you think that with the currency weakness there could be a meaningful turnaround in the way one views IT and pharma?
See, if you look at IT stocks, if you look at it from a last 6 months perspective, they have already delivered stellar returns. And that was not driven because of expected currency, the rupee depreciation. It was primarily driven because of the valuations being attractive, and the businesses obviously generate a lot of cash. Growth, etc., has been of a challenge, and even now most of the companies have guided for high single-digit kind of growth, and some of them may be low double-digit growth. So the question in the IT stocks or IT industry is basically about growth and opportunities in terms of the valuations. My sense is that to invest in any sector or any company basis just one parameter, which is either, in this case you're talking of currency, is not the right way to look at investing. There are a whole host of factors that you consider before investing. And IT, as I think they have done reasonably well. Most of the stocks now probably are quoting at very high valuations vis-a-vis the foreseeable growth in the industry. So my judgment is that the run-up has been done. As far as pharma is concerned, we all know in the last 2 years what are the headwinds most of the pharma companies have been facing from their US business. Probably reflected, most of it is reflected in the stock prices. But still, it's still work in progress as far as maybe the stocks have, in terms of performances, have bottomed out. But valuations for the return ratios which are foreseeable in the next 2 years versus that valuations are still slightly expensive. So maybe 1 more year of pain is there before we can look to invest. For long-term investors, maybe they can start accumulating at every decline. But still some more time to go as far as most of the pharma companies which are very US focused as far as they are concerned.
KK, the other interesting aspect of this market is that big is getting better, expensive is getting more expensive, and I don't know how to define more expensive stocks when they get even more expensive. So why is that only 15, 20, 25 stocks in this market are holding the market higher? If I knock off a Asian Paints, TCS, maybe a HUL and ITC from the equation, the rest of the market is looking very hollow. And this kind of a polarized market is never good news.
I agree with you, Nikunj. I think you have hit it on the head when you have mentioned about. So somewhere I think institutional investors tend to hide with each other in terms of in the stocks that they invest in. So currently the momentum seems to be with the names that you mentioned. And maybe many of the institutional investors are not adequately invested in these stocks. So the momentum seems to be there and they are hiding in these kind of stocks which are very expensive, as you rightly said. And I don't know how much return can investors make by investing in such expensive stocks. Because ultimately you have to have an eye on valuations. It's going to catch up. And we have seen that happening across market caps in the last 12, 18 months. Wherever investors have ignored valuations and invested in momentum, finally it doesn't deliver returns, and then one small negative news, etc., and you lose the maximum over there. So my sense is that this is more of a hiding kind of a strategy or a relative performance kind of a strategy than an opportunity to make absolute returns.
Okay, I'm just going to spend one more follow-up question on this entire polarization of the market. Now I can argue back and say, bhai KK, the reason why this is happening is because look at earnings. They're still patchy. We don't know what banks would do. We don't know what pharma is doing. Cyclical companies are yet to go off the block. So if we have money, the compulsion is forcing us to buy or take a safety shelter in some of those 10-50 stocks. Until the time we don't see a meaningful economic recovery, which has eluded us for many quarters now, I guess the polarized nature of the market is going to be here. I mean, for someone who bought a HUL or a Titan 3 years ago, it was expensive then also, but frankly in terms of returns, they've managed to beat cyclical stocks hands down. So it's like a dilemma is what I'm trying to say. It is expensive, but yet it is making money. I think we've lost him there. Hopefully I'll be able to get a question, answer going on this question, which in a sense has puzzled me for a long time. That, price is what you pay, value is what you get. You cannot use the word value when it comes to some of these so-called consumption names. But, the margin of safety may not be great for an investor purely in terms of valuation. But the environment, the business, the volume trajectory, the bent of the economy towards consumer, all of them are pointing to the fact that there could be some more steam left in some of these stocks. Is KK back? I think we've lost him there. Okay. United Spirits, Sudarshan Chemicals are looking strong. They are reacting to numbers. Indigo is making a comeback, and Tata Motors, after yesterday's so-called, sharp hammering, is yet to recover. But I'm going to shift gears. And, okay, Krishna Kumar is back. Okay, so KK, I think we just lost you there when it comes to this good old debate. I mean, the debate, and in case you missed my question, is that I agree with you that these are expensive stocks, KK. But the grain of the truth here is, for someone who bought these expensive haloed stocks 2, 3, 4 years ago, and that time also they were expensive, they managed to beat the cyclical stocks hands down. And for an investor and for a fund manager who took faith in a HUL or a Page or a iShare or, for that matter, a Titan, he's feeling happy. So isn't there a conundrum there? Expensive, but yet they are making money.
Yeah, I mean, as you rightly said, see, these are the stocks that you mentioned are all industry leaders in their respective segments where they operate in. And so one is that obviously their return parameters and their growth parameters, the way they have grown is obviously much superior than maybe the second or the third person in town. And so there will be a paucity of floating stock, etc. investors would love to invest in. And yes, but I would say that it is not so simple. What you are saying is that maybe 3, 4, 5 years ago when you invested, they were expensive, and today also they are making returns. But there are intervening periods when even such stocks do have their consolidation or relatively underperformance versus the markets. It is that ability to stay invested in these stocks over longer time frames is what is the key criteria which enables you to be able to earn the returns that you are talking of. And as the first question or the second question you asked was about the short-term impact and how are you going to manage. So that's where the question is, that as far as you're invested in top quality stocks across time frames, they will deliver the returns despite some underperformances in the intervening period. So, I mean, it's all a function of how you are positioning your portfolios, and these kind of stocks do add a lot of stability to your portfolios. But you cannot only be invested, and somewhere you invested in such kind of expensive stocks, somewhere valuations will catch up. We have seen it over time that if they become expensive beyond a point, valuations will catch up.
So KK, if my graphic team has to make a header which says, how should one, this is the way to invest the Krishna Kumar Karwa way, which are the names and sectors which should be part of that graphic? And let me define the time frame here, 3 years. And I'll keep the market cap criteria open. But the header of this graphic would be, how can one make money by investing the Krishna Kumar Karwa way?
That's very good. See, first of all, I think let's look at the definitions of the market cap itself. As now, as you see, as per the SEBI norms, the top 100 companies become your large caps, which is around ending at 30,000 crore market cap. And then you have the next 150 companies, which becomes the mid caps, which ends at around, say, 9,000 crore market cap. And then all below that is the small cap, which is all companies below 9,000 or 8,800 crore, which are the small cap companies. See, if you go back in history and see that over a longer time frame, it is the investing which you do in the smaller caps which gives you bigger compounding returns, whether over a 3-year time frame, 5-year time frame. So first criteria according to me is that based on your risk appetite, maybe more than 50 to 60% of your portfolio should be invested in good quality companies which are below this 9,000 crore market cap, today's definition of small caps. That's the first segment that you look to invest in, because those are the companies which will create multi-baggers for you over a time frame. So I hope you have answered your question to the extent of across market cap, where will you put your money in? 60-70% should go into the small cap sector. And then maybe the balance you can split between your large cap and the mid cap segments. That's my split as far as investing is concerned, again from a 3-year perspective. As far as sectors are concerned, yes, you need to be invested. My criteria would be to invest more in the leaders of the sector that you are looking to invest in, whether it is the consumption, whether it is the leaders in the sense the leaders which you believe can become the leaders in the small cap segment. So you go into whether it's the NBFCs, whether it's the consumption, whether it's the auto ancillaries, these kind of sectors you invest in, but be amongst the top 2-3 companies which fall into this category. So that's my way of believing that over a 2-3 year period you should be able to perform significantly better than the markets.
Alright, KK, appreciate your time. Good luck, and certainly hope to see much more of you going forward. Let's take a break with the news that it's not